$318 trillion. That's the total global debt right now. Not a prediction, not a hypothetical scenario. That's the real figure, confirmed by the Institute of International Finance at the end of 2024. Here's the part that should make you sit up. The entire world economy, all the goods and services produced in a year, is only worth about $105 trillion. We owe nearly 3 times what we actually produce. Meanwhile, silver is trading at $6,400 an ounce. Why does that matter? Because this isn't new. We've seen this story play out before, again and again. And right now, we are in Act 3 of a 4-act cycle that has always ended the same way. Let me explain. The pattern is simple, almost deceptively simple, and that's why it's so dangerous. Most people cannot believe that something this straightforward could bring down entire civilizations. Act 1, a nation begins with real money. Gold coins, silver coins, something tangible, something with real value. Trust is built, trade thrives, economies grow. People believe in the currency because it represents something real. Act 2, the government needs more money. Maybe it's a war, maybe it's massive social programs, maybe leaders just want to maintain power. They start manipulating the currency. Coins contain less metal. Paper money is issued without backing. The government assures everyone it's still valid, and for a while, people believe it. The money supply balloons, while the real wealth behind it remains unchanged. Act 3, inflation begins. Prices rise. The currency weakens. People exchange paper money for anything tangible. Land, commodities, gold, silver. The government panics and prints even more money to meet obligations. This only worsens the problem. Prices spiral out of control. Trust collapses. Society begins to fracture. Act 4, the currency dies, sometimes quickly, sometimes over decades, but it always dies. Governments either introduce a new currency or return to commodity money. Economic resets occur, civil unrest erupts, entire regimes can fall. Here's the crucial point. Those who anticipate this and invest in real assets survive. Those who rely on paper money lose everything. Let's look at history. Rome, 64 AD. Emperor Nero faces a crisis. The Great Fire of Rome has destroyed 2/3 of the city. He is at war with Parthia. Civil unrest is draining resources. The Jewish revolt consumes money. Rome's silver mines cannot meet the demand. Nero acts. The denarius, Rome's silver coin, had been roughly 95% silver since Augustus. Nero reduces it to 80%. Same coin, more coins, less silver. The immediate problem is solved, but the precedent is set. By 197 AD, Emperor Septimius Severus needs to keep his soldiers loyal. He doubles their pay, but the treasury cannot cover it. The denarius falls to 46% silver. His son Caracalla pushes it further. By 215 AD, a new coin is issued, supposedly worth 2 denarii, but it contains only 1, 5 times less silver. By the 260s, under Gallienus, silver content collapses to 5%. Coins that were once silver are now bronze with a thin silver wash. The effects are devastating. Grain prices triple. Soldiers refuse coins and demand payment in goods. The economy partially collapses. People hoard older coins with real silver. Bad money drives out good. By 310 AD, Constantine introduces an entirely new currency to restore order. The old denarius becomes worthless. Millions are required to equal a single new gold coin. That's the pattern. All 4 acts. Rome, the dominant power of its time, followed the same destructive sequence, just like America today. Next, Germany, 1914-1923. Germany abandons the gold standard when World War I begins. Leaders assume the war will be short, with the losers paying for everything. Germany loses. The Treaty of Versailles imposes 132 billion gold marks in reparations. In today's terms, that's over $500 billion. Annual payments consume roughly 25% of their entire GDP. The new democratic government wants to keep voters happy. They want to rebuild. They want social programs. Tax revenue covers only 37% of what they're spending. So the Reichsbank begins printing money. Before 1914, Germany had a gold-backed mark, one of Europe's strongest currencies, a solid foundation. Then they begin printing to cover all expenditures. Early 1922, 160 marks per US dollar. Bad, but manageable. By December 1922, 7,400 marks per dollar, a 46-fold devaluation in just 6 months. Then 1923 arrives. France and Belgium invade the Ruhr to seize resources as payment. The German government supports a general strike, paying 2 million workers not to work. The printing press goes into overdrive. June 1923, 192,000 marks per dollar. October, 170 billion marks per dollar. November 4th, 2 trillion marks per dollar. People haul wheelbarrows of cash just to buy bread. A student orders coffee, and before he can get a second cup, the price rises 40%. Workers are paid twice a day because morning wages are worthless by the afternoon. Farmers refuse to sell food for paper money. People starve. The middle class is destroyed. Within a decade, the trauma and desperation from this collapse helped bring Hitler to power. November 15th, 1923, the government introduces the Rentenmark. 1 trillion old marks equals 1 new Rentenmark. The old currency is declared worthless overnight. Everything resets. Same pattern. All 4 acts. A nation with some of the world's best engineers and scientists could not stop it. Now, the United States, August 15th, 1971. President Nixon goes on television and closes the gold window. Foreign governments can no longer exchange dollars for gold. The dollar had been backed at $35 per ounce since the end of World War II. Nixon says this is temporary, says it will stabilize the dollar, it never reopens. Before Nixon, from 1944 to 1971, the dollar was backed by gold. Other currencies were pegged to the dollar. This system created the post-war boom, stable international trade, monetary order, a real foundation. But by 1971, there were 4 times as many dollars in circulation as there was gold to back them. The Federal Reserve had been printing to fund Vietnam, the Great Society programs, and expanding government commitments. After Nixon closes the gold window, all constraints disappear. The 1970s, stagflation, oil shocks. The dollar collapses against real assets. Gold rises from $35 per ounce in 1970 to $850 by 1980, a 24-fold increase. That's not gold going up. That's the dollar being exposed for what it truly is. But the printing never stops. Financial crises continue to generate trillions in newly created money. The 2020 COVID response, $6 trillion in 18 months. Today, U.S. national debt is $36.1 trillion. Annual interest payments, $892 billion more than defense spending. By 2034, interest alone is projected to reach $1.7 trillion per year. Here's what's happening now. Before 1971, productivity increases led to rising wages. Since 1971, productivity keeps rising, but real wages stagnate. The wealth gap widens. Asset prices inflate while purchasing power erodes. In 1971, a median income worker could save for a house in 2.5 years. Today, over 7 years, food costs more, energy costs more, healthcare costs more. The middle class is being squeezed from all directions. Globally, trust in the dollar is weakening. Central banks are diversifying reserves. BRICS nations openly discuss alternatives to the dollar. China and Russia are accumulating gold at record rates. We are in late Act 3. The crisis is building. So, where does silver fit in? Throughout history, when currencies collapse, people turn to real assets. Gold and silver have been money for 5,000 years. Not tradition, because they cannot be printed, debased, or created by governments. Gold trades at around $2,300 per ounce. Silver, $64 per ounce, a ratio of roughly 67 to 1. Historically, the ratio averages 15 to 1 and 50 to 1. During currency crises, it tightens sharply. If the ratio returned to 50 to 1 with gold, where it is now, silver would trade at $80 per ounce, a 34% increase from current prices just to reach the historical average. But the pattern is clear. In Rome, as the currency collapsed, citizens hoarded silver coins. In Weimar, as paper became worthless, people traded for tangible goods. In every currency crisis throughout history, precious metals become the refuge. Silver, serving both as industrial metal and money, is trading near multi-year highs while global debt sits at $318 trillion. Central banks continue printing without limit. The pattern is unfolding in real time. Inflation-adjusted highs, silver from 1980 would be $194 today. 2011, as high, adjusts to 70. We trade at 64. The metal that has been money for millennia is priced as if nothing is wrong, as if this debt can somehow be managed, as if this time is different. And that is exactly what they always say. This time is different. American exceptionalism, the dollar's status as the world's reserve currency, modern monetary theory, technological innovation, strong institutions. These were the very same arguments people made in Rome when it dominated the known world. They were repeated in Weimar Germany, one of the most advanced nations of its time. The pattern doesn't care. You cannot sustain $318 trillion in debt against only $105 trillion in economic output. You cannot debase a currency forever. You cannot print your way to lasting prosperity. These are not opinions. These are mathematical certainties. The laws of economics work like the laws of physics. You can ignore them, you can deny them, but you cannot break them. And when they reassert themselves, it happens fast and without mercy. Silver is not a speculative bet. It is insurance. It is a hedge against the undeniable fact that this debt structure cannot continue. It is a wager that history does not stop applying just because we have iPhones and artificial intelligence. At $64 per ounce, with the gold to silver ratio at 67 to 1, with debt at all-time highs, with relentless money printing, And with interest rates trapped because raising them would collapse the debt structure, the risk-reward scenario is staggering. This pattern is executed for over 3,000 years. It worked in Rome. It worked in Weimar Germany. It worked after Nixon closed the gold window. The machine doesn't care what you believe. It doesn't care what you hope. It simply executes. And right now, it is executing. Buy silver not because you think the world is ending. Buy it because you understand patterns. Buy it because $318 trillion in debt demands a resolution. And every historical example shows that resolution comes in the form of real assets repricing against failing currencies. Buy it because the people who hold real assets when Act 4 arrives are the ones who survive. The machine is running. The only question is whether you will be ready when Act 4 begins. If you want to know exactly how this machine was built, who engineered it, and what steps you need to take to protect yourself when Act 4 hits, subscribe now. The next video will break down the mechanics of currency creation, why central banks are quietly stockpiling massive gold reserves while claiming inflation is under control, and the 3 assets that have survived every single currency collapse in recorded history. This is not conspiracy theory. This is pattern recognition. And the pattern is screaming at you right now.